Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Okay, folks, for the last 2 months, I have been beating up Pie Charts Are Us, the live charts from Pie Charts Are Us advisors from stripmalladvisors.com. And I've been getting a little bit of flack, everybody, and you know, it's been negative. And
2 months, more like 6 years, Dan.
Well, that's true. That's true. But Don and I talked because after the Trump's State of the Union address, we got a little jazzed and we said, you know what? Forget about just railing and beating up the broken Pie Charts Are Us portfolios. Let's fix them. Let's make pie charts great again. Let's fix them and let's make big, beautiful pie charts. Pie charts like we never seen before. The best, most beautiful pie charts ever. With a sell discipline. With Robotection. But anyway, speaking of Trump and tariffs and a little extra volatility, how will you invest your money so you don't get creamed right now? But that's why we have Robo. It's the little brother of Grotection that has individual stocks. That's our flagship. Now, you know, if you've got enough money, you want to do Grotection. You don't want to do Robotection. Really, Robotection is ETFs only. It's kind of a sector rotation, and it's for smaller accounts. So I rarely Robo, but when I do Robo, I only Robotection because I have the protection that is Robo. Price is truth, and you don't want to buy and hold, buy and hope. And that's because sequence of returns. Look, you can Google it, folks. Sequence of returns says that you save $500,000 every month, you annualize 8% average returns, and you have this pie chart and you set it and forget it and you have the $1 million in the gold watch at 65. Guess what? Now their studies show that you may have $1 million or you may have $500,000. It depends on the order the returns happen. That's why it's important. The other thing, folks, remember I've been telling you for the last years, Don's been talking about it. Emerging markets and international and Europe has been trash. Why do that? Why have that total portfolio? Because, folks, the way this story came up, the Wall Street, they took your money and they got to spread it amongst their real clients, the emerging markets, Europe, the municipalities, tech stocks, all the companies, all the different kinds of companies, all that stuff. So they take your money and they spread it across everything instead of just kind of the strongest sectors. And I've been saying, why have that Pie Charts Are Us with emerging markets and international? Because it's been dead money for years. It actually increases your risk. I mean, if we're going to get down to it, right? Guess what? What a difference a week makes. Europe has been, all of a sudden, Europe is going to open up the spigot, the ECB, the European Central Bank's talking about lowering rates, and Europe has all of a sudden just turned around and now it's starting to get on fire. Same thing with China. So the emerging markets now are switching and our markets are getting tough. So we have made some major kind of shifts in not only Robotection, but our flagship portfolio. We're going to talk about that all coming up. But that's why it's important, because what you're hearing from the Pie Charts Are Us, whether it's target date, asset allocation with some random date rebalancing or lifestyles, it's all the same stuff, right? So I'm going to go to the mailbag, and the show notes and the mailbag, and we've got a few articles in the show notes. I put them in there for fun to kind of pull the wool back, the Wizard of Oz curtain, so you see kind of what we're getting marketed to and what stuff that we get. So I'm going to give you some news flashes in the media. Goldman Sachs strategist warns that S&P rally faces hurdles. Well, thank you for that valuable insight. How does that help you? That just tells you, buckle up, Buttercup. You're just going to have to ride it out. Here's your pie charts. All right. And not to be outdone, the 15 worst stocks in the past decade. How does that help you? Well, let's review. Don't buy and hope. Don't hold those stocks. I've got a list of them. All right. It's in there. Macy's got slaughtered. Gilead Science slaughtered. Intel. I thought Intel was a big blue chip, big great stock. Biogen. CVS, they may be Walgreens. All right. These are big blue chip stocks. They've been doing terribly. That's why you just don't want a big smattering of everything. That's why you should focus on the strong areas. We're going to talk about that. Oh, and this is my personal favorite article. I promise you, this is the title of the article. I did not make this up. So ladies, don't get mad at me. Annuities without the C word. Literally is the name of the article. I kid you not. Fee-only annuities that advisors can learn to love. Folks, if you got to learn to love them, is it really worth it? I mean, when you met your spouse, did you have to learn to love them, or were they something special? Just asking. And then Fidelity rides model portfolio boom as ETF takeover gathers pace. You know what the model portfolio stands for, right? Pie charts are us. Every time you hear the word model portfolio, replace it with pie charts are us, because that's what it is. We don't do model portfolios because our model portfolios have to get adjusted every day based on market feedback. Price is truth. Okay? That's what I want to talk about. All right. Now, I'm going to read this mailbag. We got this. This actually came from a client right before the thing. I even talked to her because this hits right to the heart of the topic right now, the way people feel right now, behavioral finance. Okay? Remember, no matter what people say, just replace it with these words. I'm scared, and did you make me money? Or did you not lose me as much when the market got creamed? That's what most people want. Okay? All right. So I put these little notes. I want to keep this short and to the topic because in the mailbag, we got lots of praises of last year's results. We keep getting them in. People are doing their doing everything. And some of them are not as active, not the stock nerds. So they're kind of dribbling in. I'm still getting, kudos from last year. But because the current market risk, people's risk tolerance changes. See, the regulators think that risk tolerance is static, stays the same. No. It depends on what the market's doing. When the market's crashing, you're terrified, you're scared, your risk tolerance is low. When the market's going up, everybody wants in, everybody wants aggressive. So anyway, that's why it's better to measure the market risk, not your risk. Anyway, I said this is the unfun part of the market when it pulls back, right? For Revere clients, this is the unfun part of the market, or worse, a correction or even bear market. But with Revere, the pullback, this part right here, is the painful, not the correction of the bear market, which we'll welcome because we'll be in cash. In fact, well, I'll read it and you'll understand. Okay. Hey, Dan, I was thinking about putting all my stuff in cash. I'm very concerned about the market. Can you please help me do so? Would love your thoughts. I am also very concerned and scared about the markets, and that is why I have rules to get out of my own way. Price equals truth, no exceptions. If I sell you out now, I would not know how to get you back in without guessing or completely waiting for the next cycle. This may be it, meaning this may be the big one, the correction, the bear market, or this may hold right at near the 200-day moving average, a key long-term level. Don will talk about that in a minute. Speaking conceptually, though, and just so you are aware, because some of our clients are not, we got stock nerds and we got people a little more passive. Speaking conceptually, though, and just so you are aware, we are already very defensive. We were down approximately half as much as the S&P both the last 2 days. S&P got taken to the woodshed. And a third as much today as of this email. We have only 35% exposure in S&P with no individual names. If the S&P breaks and holds below the 200-day, we will also exit those last broad positions and be all or mostly in cash. We will bounce around with the markets on the first single-digit losses up to about 8 or 10%, and getting more defensive as we breach 5 in successive layers. And then in parentheses, I put really based on more technicals. Don can talk about that. And actually, the best thing that could happen to Revere clients is for this whole market to go down in the short term, because we'll be in cash quickly, and the more the market declines, the better. I just feel sorry for the people without a sell discipline or a pie charts or us portfolio and relying on buying and hold. This is a perfect topic for the podcast because everyone is nervous, even Ted. And of course, this will make the mailbag and it will be anonymous. Thank you. And I am nervous too. Anyway, with that backdrop, because remember what a difference a week or a month makes, folks, when the market hits a primary uptrend and it goes pretty much up solid, strong for a year and a half, or, without any pullbacks at all, any meaningful ones, and all of a sudden we get hit in the nose, even though this is kind of single digit on the S&P, a little more, it feels like it's massive. I mean, people feel like they've already lost 15 or 20%. It's still just single digit. This is just a single digit pullback so far. Well, not on some growth stocks. Some of those got taken to the woodshed. That's the whole point. You can't have a pie charts or us set it and forget it lie chart unless you want an average mediocre 7% return, and you got to learn to live with 35% drawdowns about every 5 years. So if you want a better way, either Grotection or their little brother Robotection, and we're going to talk about the markets and what they're doing right now. Don, bring it home, brother.
Thanks, Dan. Quite an introduction there. And I want to start off with the way we classify different types of markets according to the way we implement our strategy. And over the when we do the nightly videos, we over the last 2 weeks, we've shifted from uptrend to short-term pullback, and then to mild correction. And that's just based on the percent that the S&P 500 is relative to its recent highs. So earlier this week, we went to mild correction. The correction is a lot worse if you're looking at growth names, and that's why we track those separately on our trend gauge. There's a big difference between how the market is doing and how leading growth stocks are doing. But right now here we are in mild correction, but with today's pullback, we're approaching the 8% down off the high for the S&P 500. So we're transitioning from mild correction to moderate correction. And then based on the way that we handle our portfolios, this is what our expectation is, what we should be doing against the market. And while this mild correction is now approaching 8%, that's pretty much in line with what our Grotection strategy is off of the highs. Every night in our video, we talk about two things: our RVAB, which is Revere Volatility Adjusted Beta. That's how much exposure we have to the market. And we talk about REBAR, which is Revere Estimated Balance at Risk. And yesterday, we were down to estimated balance at risk of 1.02%. That means that will be our projected losses. Now, this is plus or minus a little bit here, but our projected losses from where we are right now would be 1.02% until we're completely flat with the market. And that's based on our line in the sand. We talk about this all the time in videos. The market never gets into serious trouble unless you break this level. This black line is the 200-day moving average. And we undercut and touched it yesterday on the S&P. We've been below it for a while, a couple of weeks on short term or on small caps, and then recently mid caps joined as well. This week the NASDAQ 100 joined, but finally today the S&P 500 has given way. Based on our prior studies, I give about a 2 to 3% overshoot on this. We don't want to get out, especially when we're extremely oversold, which we are. We don't want to get out, have one of the textbook sharp bear rallies that happen all the time. So we don't get completely out. And there's a study that recently came out. Somebody published it on Twitter, and it's in line with our historical observations. And it's once you break the 200-day moving average over the next 2 weeks, if you get more than 3.5% below that level, what usually transpires is more significant losses. But if over the next 2 weeks you just hang around that 200-day moving average plus or minus 3.5%, you could see a rally off that. And if we can just want to go back for a good example on this, was in October 2023, we broke the 200-day moving average. And over the next 2 weeks, the lowest we got versus the 200-day moving average was 2.9%. It was a little bit closer to 3%. So consider that a line in the sand below the line in the sand. you don't have to just pull the ripcord immediately. There's some nuances to this. So this is one of the nuances, and I was actually glad to see somebody else independently acknowledging the same types of things that we've had. Here's another example back here in March 2023. We broke below the 200-day moving average, but again, we didn't get more than 3% below that level before we started to rally back up above it. So,
hey, Don, can I want to add one thing, that because that's a very, very interesting, folks. So the 200-day is such a key line in the sand, and a lot of big institutional money in pension funds, right? And they key on that. And if it breaks below, they've got hedging, and they've either got to get defensive or they've got to do something. They've got to raise cash. So when it hits the 200, quite often it'll just flitter up and down right around that level and hold and then go back. So it actually is a good support level. But what Don's saying is, if in fact it does break and it breaks below that 3.5, it can go down and it can really flush fast. And you got to be ready to pull the ripcord, because that's where that other 20, because it's already pulled back 10% at this point, right? 10 or 12, whatever.
8%.
Yeah, 8%. But when it hits a 200, all right, so because the bear market's 20% or more. So that next 12 or 15% can be a very rapid flush. And that's why you got to be able to do that. And there's lots of traders that will use something like what Don was mentioning. Well, they'll do a 2-day delay when it breaks the 200-day. They'll give it a 2-day delay, or they'll see if it reclaims it. You know, they'll have some kind of rule to give a little bit of a hesitation, because it often reclaims. Go ahead, Don.
Yeah, there's also this support level going back to where this was resistance before we broke out in September of last year. It's around this 5670 to 5700 level. We tapped it, failed, broke through it, pulled back and it held, pulled back again and it held. So this is a pretty big area. And again, it coincides with that within that 3% envelope. So that's something that we're keeping an eye on before we completely pull the plug. So that's an overview of the current market. Now and also I want to note, this day when we broke the 21-day moving average on the S&P 500, that was February 21st. That was the day we got out of all of our growth names, all of the individual names. I'd taken 3 quarter-size positions since then. Got stopped on 2 of them. The other one we just sold. Let's look at those charts real quickly, because they say when they raid the house of ill repute, they come for the piano player too. Lilly was a stock that was holding up extremely well, changing character on it today, down 4%, breaking the 21-day moving average. The other 2 were Starbucks, which was holding up extremely well on a relative basis. That got hit yesterday. We stopped out of that. And then Nutanix was holding up very well after its gap up on earnings. That gave way below the low yesterday, and we stopped out on those. Combined, these only cost us like 0.23% of the overall portfolio. And that was with us holding on to the 200-day moving average, bouncing there. But that gave way in these last couple, excuse me, stocks. It gave way yesterday, and then today we're giving way the 200-day moving average. Let's transition.
Don, I want you to explain. So I don't want that to go unnoticed. So Don knows each position. He knows what effect, if our stock gets hit, the total effect on the overall portfolio. So those 2 positions, he said it only had a negative 0.2% or whatever it was. Does your advisor talk like that? Do they understand that? Are they, when you're talking about a position that he bought a stock for you, when he says, hey, I think we ought to buy this, you ought to say, okay, where's your stop? See what he says. See if he even has an answer or even thought about it. Okay. Sorry, Don.
Yeah, so let's transition now to make pie charts great again, which is what our Robotection portfolio does. Now, normally with Robotection, these are for accounts that are under $10,000, and we split it by asset classes, because they can't really, it's not enough to get into individual names, but we run it as asset allocation, which is what pie charts do, but we run it with stops, which is what the typical pie chart do not do. And by making them great again, we're turning them into cheesecake charts. Now, doesn't that look better than any pie chart that you would ever see? I mean, who doesn't like cheesecake better than pie?
Somebody went to
So
Cheesecake Factory last night with Nikki.
look at that. I didn't, Dan. There's lots of pictures of cheesecake wheels out on the internet, however,
Okay.
and these are not on my current diet anyway, but that's a whole different story. So make pie charts great again by turning them into cheesecake charts. What does this mean? These other two examples that I showed with the S&P 500 just breaking the 200-day moving average, and it got back above there. Other asset classes at that time were doing terrible, and I'm talking about foreign stocks. VXUS is the developed world outside of the US. In other words, international stocks, VXUS. Now, this chart looks a heck of a lot better than the S&P 500 is right now. They've been outperforming all year, but as of late, especially this week with Germany, normally sticks to a budget deficit of 0.35% of their GDP, even though the Eurozone has a target of 3% of GDP for a budget deficit. So Germany announced they're going to stimulate the economy with a bunch of spending, and this goosed European stocks even more. So you can see that this was the gap up day on there out of a really nice handle. It made it higher. VXUS, here's another one, FEZ. This doesn't include Australia or any Asia. This is just Euro stocks, and that's even better with the gap out of that cup and handle-ish base. So we added VXUS to our Robo. We're looking at FEZ for Grotection as a way to, we say, don't diversify into rotten vegetables. Well, these vegetables aren't rotten anymore. They just showed up at the store and they're looking pretty good while the U.S. is deteriorating. So this is something we're looking at taking a shot at. China has been outperforming too. Another ETF that we're looking at is possibly taking advantage of that is KWeb. That's forming a very nice cup and handle base. Attempted to break out of it yesterday, pulling back slightly a bit today. So those are two. And then also the administration is making a concerted effort to get longer term rates down. This is a chart of TLT. This is the 30-year. This pulling back and bouncing at the 21-day moving average was a very low risk entry. Ted and Connor took that for turbotection. I'm looking at something a little more tame, which is the 10-year for Grotection. You can see it pull back, bouncing at the 21-day moving average, and it's up today as well. So what we're doing is reducing our exposure to U.S. stocks, which have been on an extremely strong bull market since November of 2023. And as they deteriorate, our stops get hit. We come out of that. We take a look at these other asset classes and see, are they worth owning? Gold we've owned for quite a while now. Why? Because it's been performing very well and showing relative strength. We've had it in Grotection. We've also have it in the Robotection portfolios. Another asset class is emerging markets. I mentioned China in particular. We're not as happy with broad emerging markets because India and some of the other Brazil are dragging this down. We would rather focus on China right now, which is the KWeb ETF. Another asset class that we will frequent when it's outperforming is Bitcoin, with a small percentage of the portfolio, a little higher percentage if it's turbotection. But here's Bitcoin. It's underperforming. It's under the 50-day moving average, above the 200-day moving average. We have no current Bitcoin position across the portfolios. So that's our approach with making pie charts great again, is to go into these asset classes that we've been downplaying for years because they haven't been outperforming. All they've been is a drag on performance if you've been in them for an extended period of time. But if they have their day in the sun, we're going to participate because we're technicians. We can read the charts. We can see what's going on. It lines up with the macro, with Europe increasing their budget deficit to do spending to goose their economy. So if 1 and 1 makes 2, if 1 plus 1 equals 2, both on a macro, fundamental, and a technical standpoint, we're willing to take advantage of that. And as the U.S. stocks deteriorate, we're just rotating out of that. We still got our line in the sand here. but we're looking at the rest of these other asset classes to see if they can provide us some return.
So folks, listen, that is the key thing. That's so key. Don is managing risk by measuring the sectors and the individual stocks themselves. And as if they're weak, if they're selling off, if they're trending downward, he's out. He's not in them. So we're not in weak sectors and areas. So we're managing risk based on the risk of the market, the sector, and the asset itself. The asset, how much risk is in the market and the asset, not your risk tolerance. Because even if you tell me you're super aggressive, you're very aggressive. If Tesla is crashing, I'm not going to own Tesla stock because it's stupid to own a crashing stock. So let me ask you a question. If you tell me you're really, really aggressive and Tesla is crashing, going down 15, 20% or more, do you want me to hold it for you because you told me you're aggressive? You need to ask yourself that. You need to ask your advisor. If a stock is going down, do you have a sell discipline or do you just hold it because I told you I'm aggressive, that I can handle it? Look, I can be aggressive. I'm a sophisticated investor. I'm all that stuff. I don't like holding stuff going down. I just don't. Makes me uncomfortable, pisses me off. I don't like it. I don't like losing money anywhere, anytime, for any reason. That's just me. Now, in the pie charts are us, the old pie charts are us, not Robotection. The pie charts are us. What they're doing is they're spreading it out and smattering it across everything, and that's how they're managing risk. So you got all that mediocre stuff, I was going to use another word, that doesn't go up very much, so you get a very, very mediocre return on the way up. The problem is correlations all grow together, and when it hits the fan, they all go down together. It doesn't protect you. You got to go to cash like we do. So we've never had a bear market ever. We've never had a 20% decline in Grotection. And we generally barely breach the double digits, low double digits, when the market's down 20, 30, 35%. That's a much easier ride. So I measure risk with total portfolio drawdown. How much did I lose? How much did I pull back? And Don's got measures of those on every single position in the portfolio and the portfolio in its entirety, meaning if everything got hit at once on a day, on a really, really ugly day, how much would the portfolio, is estimated balance at risk, how much would the total portfolio take a hit? Does your advisor measure that on a daily basis? Just asking. All right, Don.
I also want to point out one other thing that's really helped us catch the turn in this, and that's the RG8. That stands for the Revere Growth 8. It's 8 ETFs that we track to keep our finger on the pulse of what's going on in higher beta growth stocks. This is a picture of the Russell 2000 Growth Index. And I want to point out February 21st, that day when we sold all of our stocks. This had a huge break. It had been lagging on a relative base, as you can see. It broke this day, and look how far below the 200-day moving average this is.
That's
so what we're doing is
risk. That's managing risk.
That's managing risk. So we had noticed that we had false breakouts in these. I'm going to look at two more that are components of the RG8, the FFTY. This had us very excited seeing this breakout here in this is the IBD 50 index, which is, as I said, a measure of the RG8. This had a breakout from a very nice flat base on February 13th. It went up for 2 days. It reversed. It went back into the base and tested the pivot. Really nothing to worry about. That happens all the time, retesting the pivot. But then look at what it did on February 21st. Hard break below the 21, hard break below the 50, down 7.4% in 1 day, and it's continued to the downside. This is actually down 20%. So this has had its own bear market. Mm-hmm. And the other one is ARKK. Same situation, broke out to new highs, trying to run higher. It reversed on the 21st. It had a hard reversal below the 21 and the 50, and it's continued down below the 200-day moving average. So this is a move down from 68.40 to 50, which is also a 20+% break. So
Yep.
the RG8 doing its job for us.
Yeah, by the
If
way,
we're looking,
so we always say it's okay to be wrong. It's not okay to stay wrong. Don started getting in because it looked good. It turned around. It got out right away. And that's how you manage risk. One last thing. I'm sorry, Don, because we're really pulling back the curtain, because Don gets real technical and I try to put on the Don interpreter so the layman understands it. Folks, he came up with that R8 because years ago we had a little mini bear market in the growth stocks and the S&P, and we got taken a little bit to the woodshed. We never wanted to have that happen again. So we actually made a bit, and we created that R5, which is now turned into R8 growth indices. So we see that sector rotation very quickly. We shared that research with you years ago. So we're doing this in real time live, and Don's sharing all that research. All right, Don.
Yeah, February, March 2021 was a tough period for growth names, and we had a little bit bigger of a drawdown than we wanted to, went into the laboratory to find out exactly what happened, and this was the result, the RG8. So that's it from a make pie charts great again by making cheesecake charts with stops, where we are on the current market. And let's go to the fellas now. We're going to start with Ted. Ted's going to start about a possible, you don't want to fall into bear or bull traps. Ted's got a chart he's going to share, and take it away, Ted.
Yeah, so we're going to continue this theme of talking about shorting since it's really relevant right now in the current state of the market. Connor tweeted this yesterday, if you follow his Twitter. And this is a picture from Mark Minervini's book and his Master Trader program. But this is actually from his book. It says in the bottom left-hand corner, trade like a stock market wizard. And pretty much the conclusion of this post is that with growth stocks, which is what we mainly traffic in, on the uptrend, that is when they actually have extraordinary high PEs. And what that means is people are willing to pay up and pay higher and pay a greater multiple for the stock because they expect huge acceleration in earnings and sales. And they continue to project that forward into the future and are willing to pay up for that in the present. However, when a growth stock tops, like that Crocs back in, I think that was, I forget what date that was, in 2006, that huge weekly sell candle, that huge weekly sell candle actually was on earnings. And on that earnings, they actually beat and raise as well. And that is why you see that PE drop drastically as well on earnings. Well, that earnings plus a drop in price is why you see that PE in the bottom panel drop so significantly. And the problem is that when the PE actually drops for growth stock, investors and traders are forecasting lower future earnings and revenues. And that's why they start selling the stock, because they're done with the growth portion of the move. They're on to the next growth stock. And that is when the downtrend really happens. And this is what Minervini and what we like to call the value trap. A lot of people fall into this trap because they miss the move in the beginning. And that's quite typical for retail investors and amateurs. They'll start chasing the later stage bases and later stage moves. And then they might not even catch those later stages and miss it completely. But when the stock drops 30, 50% off highs, they see that the PE is coming down now relative to previous times. And they think that's a bargain. So then they start buying. But because your thesis is that it's cheap, when the stock drops more, the PE drops more, and you still think it's cheaper, so you actually average down. And that really can lead to disasters, especially in growth stocks that top and drop an average of 72%. And that 72% we've cited multiple times on this show and in our videos as well. And really, we just can't stress enough of the magnitudes of the drops that growth stocks can face, especially after they put in a secular top. And so continue on, I've shared this next chart so many times now. Can you pull up the weekly chart of ANF? From all the hours of studying stage analysis and the cycles of growth stocks, I can't really think of a better model example than ANF. You could definitely find many in the past, but in recent times, ANF is just absolutely perfect. From the last downtrend in the inflation bear market to the stage one basing period in that late 2022 to 2023 period, and then this uptrend, extraordinary linear uptrend trending above the 10-week moving average, pretty much the entire move. You had that brief correction back to the 20-week, and then it made a final move before topping, but you can't really find a more linear stock than this one. And really, the earnings and sales numbers from that previous downtrend into this uptrend and into the topping portion of this move is really a perfect example as well. You had negative earnings for 5 quarters in a row. Then you had a huge surprise in that June 2023 quarter or around that time frame with acceleration in earnings and sales, positive beats, and that's what ignited the move. And it ran over 500%, and you can see the earnings and sales continued to come in. And actually, at the top, you still have decent sales, still triple digits. If I'm seeing that properly, it's a little blurry on my side, but that's actually when it topped and started distributing. Institutions started forecasting a deceleration in earnings and sales because stocks can't grow on forever. Trees aren't going to grow into space, and that's when they start selling their shares. And that is the distribution action you see at the top, this huge 8-month base. You have the longer term moving averages of 30, 40 week, which I've emphasized multiple times on the show as well, catch up to price. And it's starting to slice within price, with price oscillating in between those moving averages. And that tells me the move is tired and there's a higher probability of this being the end of the move, especially after over a 2-year move and over a 600% plus gain since that stage 2 uptrend breakout. And then the dagger in this stock was they raised guidance, but it dropped 10% into a downtrend below all key moving averages. When you have good news and it goes the exact opposite direction, that is just the biggest red flag in the markets. And it's really just been a linear downtrend ever since for the last 6-7 weeks. And like I said about the value trap, actually a few days ago, we had earnings. They had double beat, but they lowered guidance again, and you continue to see deceleration in earnings and revenue. So this PE is probably, I don't have the graph of the PE handy with me right now, but I would suspect that this PE is a lot lower than the move or than the PE during the uptrend. So the second stock I want to talk about is the most coveted stock in the market, and I talked about this stock last week on the podcast, and then a few weeks ago, early February on the podcast as well, ushering some warnings about the stock and to not fall off with really any stock, even NVIDIA here. I mean, there's so many warning signs in this topping process. It started off just with that huge break on the weekly chart all the way back to the 30-week moving average. That's first signs of distribution. It's a lot sloppier, a lot more volatile. You can get that feel because prior basis was really tight and orderly, those consolidations. And now it's getting extremely wide and loose. That's one sign. If you can go on the daily chart, there are multiple what we call news failures or failed breakouts as well. The first one started last quarter on earnings. Huge beat and raise, a lot of hype about Blackwell, the introduction of Blackwell and huge future demand for Blackwell. We broke above 150, failed back into the base, and then we pretty much pulled back the next few weeks. Leading up into the CES technology event, we briefly made a new high again, and then just a huge sell candle once again. And institutions look for these types of liquidity events to sell into when they do think a move is done, because they can't sell whenever they want because they have too much money moving around. So they have to wait for these liquidity events where there's a lot of hype, there's a lot of good news in the media, and a lot of retail traders start pouring in, expecting a lot more growth to the upside, and they see that opportunity as a time to distribute into the market. Another couple weeks later after that, we had the deep seek gap down on the biggest sell candle and volume really in the last few months. And that was followed by a wedging rally on declining volume, which just means there's no real buyers coming back into the markets to support NVIDIA. We rallied into that left side peak of 140, failed there, sold off into earnings a little bit. And then on earnings, we had another double beat and raise. Talked about Blackwell, how there's so much demand, billions of dollars flowing in. We had Stargate apparently investing 500 billion into AI infrastructure. We had some other news like Saudi Arabia's fund investing billions as well into the US on AI, and it just can't go anywhere. And you would think that that great of news, the stock would easily be into all-time highs, but that's not the case. And the reality is that the best of news actually comes near the top when everyone thinks there's no chance the stock can't drop, and everyone is projecting that the stock will move on and move upward forever. So that's the exact opposite of what you see in a bottom, where the world is on fire and everyone thinks there's no chance that anything good will happen. And so now we've really just had a series of lower highs and lower lows. Really, the head and shoulders kind of is starting to trigger here, and we're just below all key moving averages now. And this is just a full-on downtrend. There's really nothing else good to say about the stock at this very moment. So the final stock I want to talk about, I mentioned on the last podcast as well, is FTAI. It's an aerospace and defense stock. Another one. These are the ones I like to pick on for shorting. A huge 800% plus move. Can you go on the weekly, Don? It really paints how linear this chart was. And actually, this could take the number one linear chart over ANF, and especially with the magnitude of the move. But ANF had a better stage 3 topping example, which is why I give ANF the best model book stock in this cycle, at least for stage analysis. So huge linear stage 2 move in FTAI, pretty much trending above the 10-week moving average the entire time. And why I like to pick on stage super linear and big moves in stage 2 is because on the way down, there's not a lot of support. So that can lead to big drops in these stocks. And really, it's already off like 33% from highs. You can see it once again, just huge sell candles, sell volume. I think that weekly candle was off a short report. Regardless of what caused it, it doesn't matter. Funds are liquidating the stock. And then you had this wedging rally, reclaiming all the key moving averages at one point, but on lower than average volume. And this really has just come down, broke all the key moving averages again. You can see all those MAs are declining now, and this is also just in stage 4 decline as well. And once again, a lot of these growth stocks, once they top, they'll drop on average 72%. And it coincidentally for NVIDIA, ANF, and FTAI, that's around the $50 level. So I'm really liking that number for many of these growth stocks as potential targets for your shorts.
Awesome job, Ted. And you mentioned the value trap. One of William O'Neill's sayings is that the fundamentals always look best at the top. These still look pretty darn good for NVIDIA. In fact, the PEG ratio is less than a 1 for their 2026 earnings. You can just hear people screaming at the top of their lungs what a value this is. Meanwhile, it's fitting all of the criteria for a top. And just Ted, I envy him being in his early 20s. I wish I could turn back the clock, but nobody can fight Father Time. And I wish I was exposed to this stuff when I was as young as these guys are. This is just a beautiful thing to see, watching these guys put this accumulated knowledge into action in real time. Hat tip to Ted and Connor. And speaking of Connor, let's segue over to him. Great job, Ted.
Yep. So what I first want to talk about is a couple of the shorts that I talked about the other podcast. So if you pull up a chart of semiconductors, Don, and this kind of goes in line with what Ted was talking about, but semiconductors pretty much had that very similar setup. And just talk about some of the events that have transpired since. So on February 27th, that's actually when in Robotection we shorted the semiconductors. And as you can see, that was on the NVIDIA earnings day. And that was pretty much the last hope for the bulls. That was kind of the consensus that maybe NVIDIA can bring some life back into the sector. It gapped up a little bit, and it gave the perfect short opportunity into a bunch of declining moving averages, rejected, and closed that low a day on, on huge volume. And so we took short there, and then we covered a little bit a couple days later, and we're still holding a piece of that right now. And since then, you had Avgo report earnings yesterday, and they initially gapped up 20%, but since then it's pretty much flat on the day. So again, another ugly bar forming in the semiconductor space. And then 2 days ago, you had Marvell report earnings, and they got smoked. Marvell was down almost 30% on that earnings. And, these aren't just pullbacks, these are full-blown bear markets for these stocks. And you literally can search the whole entire market and you cannot find a good-looking semiconductor chart out there. And as we've learned, most stocks, regardless of the fundamentals, they move with the group. So you can take a broad-based view, look at the ETF chart of stocks, semiconductors, and that will tell you everything you need to know. There's a much bigger likelihood that the sector continues lower than higher when there's, what stock can bring it higher. NVIDIA brought the sector higher for 2 years. Now that's firmly below the 200-day moving average. Nothing happens good below the 200-day moving average. All these, the ETF, all the stocks in the ETF are below all the moving averages. So really not a good look. And exactly what Ted mentioned, this is when you start to get these valuation fundamental people coming in because they missed the whole rally because these stocks were so expensive, and now they're quote unquote cheap, and that's the value trap. So that's semiconductors. And then basically what I kind of wanted to highlight, Don talked a little bit about the RG8, but I just kind of wanted to showcase how bad some of these pullbacks have been for stocks. If you're the average Joe that doesn't really follow the stock market, you can turn the TV on and you see the S&P 500's only down, 8% off the highs, which is pretty significant, but that doesn't display what's been happening. And that's another reason why we use the core S&P position, is because it catches the rotation and doesn't get hit as hard, and it smooths the equity curve. But with the other available cash in a good market, we're going to be focused on the high beta growth stocks, leaders of the market, and that works both ways. You get that extra fuel on the upside, but these stocks can go down just as quick. So let's take a look at, if you just pull up, keeping in tune with semiconductors, pull up ALAB. Again, this was an awesome stock. Grotection owned this, traded this for, I believe, for some piece, triple digits. And you can see, there was absolutely nothing wrong with this stock. It was one of the best stocks to own, one of the best stocks in a strong sector, multiple earnings gaps. It checked every box. It had the N in it as well. And you can see it trended up, and it all started on that deep set gap down. And then it tried to rally back up, very weak, rejected at that 21, which, was a good short setup. And now it's all the way back below the 200-day and 57% off its highs. Again, just this shows you can't blindly buy and hold with no sell discipline, because as good as this stock was, which we capitalized on, look where it's at now. And, if you're holding that, you've just given back all those gains from the run. Another one that we traded, Reddit. This one's now 35% off the highs more today. It's probably more like 40%. But again, this one was similar to ALAB. Initially, we got engaged on that earnings gap all the way back there around that $100 level. It trended up beautifully. And then once it broke the 50-day on volume, that was your warning sign. And then it tried to rally back up. Again, very weak, formed a bear flag. And this is now 40% off the highs, and it's going to need serious work to repair itself. Another one is, now we'll just go into like more of a, higher beta stock like HIMS. And this one was super strong this year, leading, we talk about it all the time, just was a tough one to get in, just ran up super hard. And just as hard as it ran up, it came down even harder, multiple gaps lower on huge volume. Tons of sell signals there, and now this one's almost 60% off the highs as well. So you could say complete destruction in a lot of the growth stocks. And just some cool stats is, if you pull up the chart of the QQQ. And now the Qs got hit a little bit harder than the S&P 500. It's now double digits off the highs, and this is the third fastest 10% drop, excluding one-day crashes in the history of the Qs. So that just tells you everything you need to know that there's been a lot of carnage under the hood, and it's likely going to take some time for a lot of these things to start to repair. And if you remember, 2021, when ARK started to break down, you had a lot of those favorite stocks that a lot of people liked. If you pull up a weekly chart of Zoom, for example, people never in their wildest dreams would have probably thought these stocks would have went down as far as they did. And it kind of seems like we're in a similar situation here. Obviously, no telling how low these stocks can go, but they already feel quite oversold, but oversold can get more oversold. So you have to have a sell discipline. You have to know when to take profits, when to sell into strength, and when to eventually just get out if the price is telling you. So I just think it's pretty eye-opening to look at some of these stocks. Don showed the RG8 composite. Those kind of showed more of the stocks that we follow. Those have all 20% decline. So it's definitely not looking pretty out there, but just taking it day by day.
Awesome stuff, Connor. That key stat that you mentioned about this is the third worst, quickest drop in the NASDAQ 100. Numbers 1, 2, and 4 both led to bear markets, or all led to bear markets.
Now that's a stat. That's a stat.
That's a stat. Now
Wow.
the key is number 3 going to do that? And let's keep an eye on that 3.5% threshold over the next 2 weeks against the 200-day moving average for the S&P. So chock full of nuggets for you to chew on as far as, can we put in a bottom, or are we going much lower? We've got some signposts that we're watching, and watch them along with us. If we're right, awesome. If we're wrong, we'll be wrong small, and we won't stay wrong.
Yeah.
In short term, and we won't stay wrong. That's it from the technician side. Dan, you can take us on home.
Great. Well, listen, I loved it. Don came up with a sniglet a little while ago. He said, Mandel. Don, he said he was mandling the portfolio. He's manhandling the portfolio. So that's Don mandling. He's mandling the portfolios. He's manhandling them for our clients so we get a good outcome. Anyway, folks, listen, don't miss the forest for the trees on NVIDIA that Connor was talking about. So if you don't understand that NVIDIA could easily drop 50% from here, you don't understand growth stocks. You don't understand that. But here's the main thing. Forget about NVIDIA dropping 50%. So there was an old adage on Wall Street decades ago, so goes GM, so goes the market. Because GM was so big, right? 50s, 60s, 70s. Well, right now, NVIDIA is so goes NVIDIA, so goes the market. So if NVIDIA, that's the bad. The whole market, it may be worse. Okay? So what's your plan? What's your plan? You got a pie chart or us? We're just going to buy and hold, hope everything's all right and all the diverse phase goes down together? Or you can have someone like Don on the pulse of the market ready to sell if it gets dangerous. See, we dial up and down risk with cash all the time and changing the allocation. We rebalance every day as needed, not just one day a year on some arbitrary date because it's New Year's Eve. Morons. Anyway, if you want to learn a better way, just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can put your name and email in there. We're not going to reach out to bug you in any way, but this podcast will go in your inbox on Saturday morning, and we do a daily market insight every night the market is open. We're the most transparent advisor that I'm aware of. If you go to YouTube and just search for Revere Asset, just Revere Asset, hit subscribe. Our producer, Zach, have this show out within an hour on YouTube, and that's how our stock nerds get it. That's our trademark. Our stock nerds get it before the market closes on Friday. For the people that aren't a little more passive, they get it on Saturday morning. So there's 2 different ways to get our content. So you don't get pie charted or us's. Learn a better way to invest at Revere. And by the way, you can always call us old school at 855 Real Wealth. We'll talk to you next week on Your Money. Not their money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.